Welcome to Opal STV. Today I'm in Hong Kong together with Barry Lau. He's the managing partner of Adamas Asset Management. Barry, please introduce yourself and Adamas Asset.
So what we've noticed is at the end of after every financial crisis, we noticed that banks stop lending, in particular to smaller companies, private SMEs. Those are companies that are typically growing at the fastest pace, require the most expansion capital. However, banks, traditional lenders, are hesitant and reticent in providing that financing. And banks are only lending to people who don't need the money or who've got a lot of cash already. So leaving the smaller companies basically starved off from expansion capital. What we decided, therefore, is it would be an interesting business model to finance such growing companies in Greater China. Now, to give you a bit of statistics, there are about 50 million private companies in China. Okay, and according to most industry known surveys, only up to 10% of such companies are in receipt of bank financing. Therefore, about 90% of the 50 million companies do not receive any bank financing. Now, this group of companies, the dichotomy is very clear because this bunch of companies they contribute to 65% of Chinese GDP. They created 80% of all employment. So to us, it's very clear that there is a great opportunity. Now, the next question is, how do you identify those good companies? Because 50 million companies, in order to identify the good ones, really takes a lot of work. And that's where we come in, because we built up our expertise and our network in this space. A lot of this is driven by proprietary sourcing capability. We currently have 20 people in Hong Kong, and we've got another 20 people based in Shanghai. Together as a team, with 40 member staff, we're able to provide institutional infrastructure to source, to execute, to manage, and to exit.
Barry, please explain to us in greater detail what sectors are you focusing on, and give us examples of how you structure your deals.
We like the consumption theme very strongly within China, and the companies that the attributes of a typical company that we would lend to would be strong cash flow, or there will be a clear cash flow liquidity event that we can foresee or we can model out in the near future. The same company should have some hard assets available by way of collateral towards our security package. And we need, ultimately, it's a people's business, we need a strong entrepreneur. And the entrepreneur will do everything humanly possible to ensure, one, that his business plan is executed, but two, which is as important, is that he will ensure that our loan is repaid on time, principal plus interest. So those are sort of the key components that we focus on. And we spend a lot of time on qualitative assessments of the management team, the owner of the business, and his stakeholders, so the suppliers, the customers, and his service providers, such that we can build a proper picture of the person that we're dealing with and the business that he's operating and so on. So we also have a team who focus on assessing the actual security. So to the extent that there's hard assets as collateral, which is a must for us. We have a team who are specialists in real estate based in Shanghai. They'll go and assess the security value using a conservative approach and also a market approach to ascertain what sort of loan to value ratio we can deduce from it. Typically, the way that we would look at an investment into financing a particular company is that company has to be growing, typically 25 to 30% per annum, right? And such companies, one may ask, how come they don't get financing from banks? Because banks would love to lend to a company that's growing at such a phenomenal rate. The interesting thing is that in China currently, banks are not financing those companies, and typically those companies may have some more interesting business angle or business models that the bank officers do not necessarily want to understand the cash flow analysis, or to acquire the knowledge in understanding that business model. That's where we shine. We want to spend as much time as possible with the borrower, the company, to understand why they are different, how they can grow, how can they can sustain that growth, and how they can ensure that the money will come back to us. On top of that, we'll throw in what we believe as the best practice for good corporate governance, such that such company, after our financing, will indeed be growing into the company that it ought to become. Furthermore, it will also meet certain international criteria and standard that we, as an international investor, have come across and would like to also transcend across all our portfolio companies. So that's sort of the mission statement that we want to bring to all our investee companies. An interesting example that we have come across, and we've actually invested and we have exited, is a resort, a high-end resort in China. It's located in Morganshan. So for those who have watched in the bamboo forest, and Zhang Ziyi, the movie star, was flying across from one bamboo to another. That's the movie. It's a beautiful scenic place outside of Shanghai, about 40 minutes drive, maybe a little longer, depending on what sort of car one drives, but it's sufficiently far away from Shanghai, from the hustle and bustle of the city. No industrial and commercial units in sight. Very beautiful setting, beautiful scenery. A local developer has established a local resort brand called Naked, N-A-K-E-D, which as the name suggests, is interesting. But what it really means is back to nature, so renewable, sustainable, and all those wonderful things embedded and embodied into the spirit of Naked. We finance the completion of Naked Retreat, which is a 120-room villa project, and this particular resort has actually won numerous accolades, including Condé Nast voting it as one of the top new hotels in the world in 2012. We've been scanting around in China to find such good consumption theme. We believe in an upgrading phase within China, with the growing middle class wanting to eat better, live better. So for this growing middle class out of Shanghai and the surrounding area, they would look for a weekend home, a getaway place, and where better than somewhere one could drive to door within a couple of hours. So we've identified a geographic location. We've identified an entrepreneur who's passionate about this theme and the sustainable theme and the upper and higher end consumption theme. He's built this resort. It's the second resort he's built, and we partnered up with him by providing the completion capital to put in all the fixtures, fittings, proper renovation up to the highest standard internationally required. This particular resort has actually won LEED Platinum status, which is the first in China for a commercial and resort operation. The LEED is the Leadership in Environmentally Excellence Development Award, and some of the criteria will require utilization of local labor, utilization of alternative energy,
Barry, what level of security or what type of pledges and collateralization measures do you actually implement?
With all the real estate, hard assets, it's wonderful because they can form part of our security package onshore as well as offshore, because we've also created a structure whereby offshore investors could buy units into in the resort, and we had cash traps of the entire resort whereby the cash accounts of the operator were pledged to us, such that we are the ones who approve money going in and money going out. So we were effectively running the resort as the CFO, if you will, until the full repayment of our term loan. Our term loan was 25% in cash coupon, 1 year transaction, and we had successful exit, fully realized right on the dot of the 12-month period. We had periodic payment on an amortizing structure basis, such that we know our cash was current and we were getting cash coming back as soon as some of the villas were sold. That was part of the agreement that we structured, that we required out of 120 villas, 30 would be sold, because that way we could foresee at the time of funding that there would be money coming back from the sale proceeds to repay our loan, and that proved to be a successful structure. And in terms of the pledging of the assets, we have a license in China, onshore in China, which differentiates us slightly from some of our peers in that we are able to enter into entrusted loans. So we partner with a local bank whereby we will enter into a tripartite agreement, and we are able to take asset pledge. So we're able to take the pledge, the charge over all the hard assets. We're able to take share charges as well on top. We're able to instill operational protection as well. What I mean by that is, we, in addition to all the legal framework, which has to be robust, we know we can execute, we can enforce, we also have a set of operational protection, including but not limited to a few of the following. One is charge of accounts, joint signature of accounts, custodianship of the CHOP. In China, it follows the CHOP, it doesn't follow a signature. In order to perfect a legal documentation, you need to have the CHOP, the company CHOP. That dictates it all. So we control that. We put it in on escrow with our lawyer. Whenever the company needs to approve certain purchases, acquisition, disposal, they need to use the CHOP, and it will be for us to approve that. We also put in directors at every level of the structure. We would replace those members that we don't believe are additive to the whole investment, and we would also amend the memorandum of articles to give us entrenched right as the lender.
So the Shanghai resort that you financed was for 1 year and a 25% coupon. Is this how you do it? Tell us more how your deals look like.
As part of the portfolio construction, we would look at a borrower and say, okay, well, how long do you need the loan for? Because we're a lender, we have many tools in our toolbox, so to speak. For a good entrepreneur with a good business, he doesn't want to dilute himself in his equity. So that's why he's motivated to work with us. He wants to borrow from us. However, there are some businesses that may not be able to provide a 20 or 25% cash coupon on a per annum basis. So we'll assess the situation and ascertain whether such a business is able to provide 20 to 25% cash coupon. To the extent that some companies do not have the means to provide that type of higher returning cash coupon, And those are typically companies with a big order coming in. They need to build additional plants to meet certain orders, which will come in, say, 12, 18 months' time. Then the term loan will not necessarily fit. What we will do then is to say, okay, we'll offer you some form of a convertible bond structure. And the convertible bond will have a yielding component carrying anywhere between at least 10 to 12% yield, with the remaining upside to be generated from either free warrants or profit sharing mechanism that will build into the structure. And we find that quite useful, because as a lender then we've got more levers to use in negotiating with the borrower, because, for example, they say, I don't want to have the burden of a high interest rate payment on a per annum basis. We say it's fine, but you're going to have to make it up at the back end through some equity participation by us. So on an overall net basis, we still target a 25% IRR per investment. Now, some of the deals are true bridging loans in nature. So those are sort of just under 1 year term. And those we will have very specific term loan structure. And we can structure it in a way that either we have regular coupon payments, or we could have a bullet payment, so long as it's within 1 year. We've also done deals that we'll collect some of the coupons up front, or at least partially, to mitigate against some of the risk associated with the credit risk. So we can be very flexible, and we'll look at every business with a fresh pair of eyes, try and understand where the cash flow is going to come in, when it's going to come in, and we'll try and match that in accordance with the model that we will build together with the entrepreneur.
So Barry, you're doing corporate credit, you're providing corporate credits to Chinese corporations. Don't people sometimes ask you, isn't this risky?
Yes, we get asked this question all the time. Is China a bubble? Can we trust the enforcement regime within China? Is Chinese law? It's very scary. Wall Street Journal, the Financial Times all talk about sort of ghost cities. Is it true? China is a big country, and for somebody who's not based locally, not based in China or at least in Hong Kong, it's very difficult to address the risk associated with China. But this is the same wherever you do business. Local expertise is really the key. What we found is, yes, there are certain risks associated with China, and but with an established network and expertise, you can navigate those risks better, shall we say. As a platform, we've done about 55 deals in China. We've financed 55 companies, of which we've had 5 defaults. We've pursued against those default companies, and we recovered from every single one of them. We've won in judgments in courts of law in China, and the enforcement has been swift and effective. So is that, can we say we've had bad experience? Yes, I mean, when you lend money to people, when they don't pay you back, it's always difficult the courts of law in China has actually been very, very helpful to us. And there are certain, I guess, procedural perfection one has to understand in order to take the fullest advantage of the way of enforcing within China. We've done a white paper on this, and we're happy to share that with you if you've got the time to review it. And it's a step-by-step enforcement mechanism within China. But in terms of the risk we see, one has to be very selective, first of all, to mitigate against that. So typically we focus on tier 1 cities in area we see the sort of hard assets that we take as collateral, typically are real estates. So we want those real estates to be in a market where there's liquidity. So typically Shanghai, Beijing, Guangzhou, Shenzhen, those are better areas for us to consider. Going to the sort of the northwestern part of China, where opportunities are abundant, however, with no edge. We have no real substantive experience in executing and enforcing that. Whereas in Shanghai, Beijing, and Guangzhou, we've had experience. As I said, 55 deals. So we're comfortable and confident that we'll be able to execute those deals properly there. And just to give a bit more statistics and background on this, Shanghai is 20 million population. Officially, unofficially, you can multiply by 2. So, it's a big enough market for us to operate.
So Barry, how can people invest with you?
We genuinely believe that what we have to offer as a platform is pound for pound one of the best solution and best ideas in allocating for investors to allocate capital to China. And to that end, we have 2 vehicles. We have 2 Cayman fund vehicles. One is a open-ended fund, and that has a track record of 4 years already. And we are actually in the process of closing a second vehicle, which is a Cayman limited partnership. That's a 7-year closed-ended fund vehicle. We've received a lot of requests from endowment funds, pension funds, that they prefer a closed-ended vehicle, as a result of which we've got 2 vehicles currently available for investors to participate in. Both have one very key attribute which we particularly like in a low yielding environment. Both vehicles will target to pay out a cash distribution of 8% per annum to investors. Each of the last 4 years, our first fund has been paying out an 8% distribution per annum. And in addition to that, our investors also benefited from the growth of the NAV too. Our NAV, together with the distributed cash, amounts to about 1.6 times the original invested capital that investors put their money in on day one. So there's about 60% appreciation as a result.
So Barry, I have to say you actually convinced me that credit in China is a great opportunity. So the question I have now is, how long is this opportunity going to last?
How long the opportunity is going to last? I mean, to tell you the truth, without a crystal ball, I can't pinpoint exactly how long this will last. But based on current studies, we believe the funding gap is around 1 to 5 trillion US dollars currently for this group of SMEs, which means it's going to take a lot of capital to digest. And notwithstanding that first point, the second point is that the IPO route is all, there's been a queue, there's a long queue, and that queue gestation period is going to be several years to digest the pre-existing number of companies waiting to be IPO'd. So from a capital market standpoint, in tapping capital, it's not very efficient. So we believe that to operate what we have in financing SME, there can't be a better time, and this is the best time to obtain a cash yield of around 20% per annum. And we believe that such companies will continue to be here, such companies will continue to want to grow, and they'll command and demand expansion capital which they're not able to access either through traditional means or through the capital markets because they can't be listed. And so they have to turn to what some people refer to as the shadow banking industry, which is a very loose term and is not as shadowy as what people think it is. So it comprises trust companies, pawn shops, financial leasing companies, credit guarantee houses, small loan companies. And then there are asset managers like ourselves. We believe that we are particularly unique because we target a 5 to 20 million US dollar ticket bucket, which the trust companies don't want to touch because it's too small. The pawn loan companies think this size is too large, so we're smack right there in the middle for those companies that are really growing, but their needs are just not met. And this bucket, we believe, is the size of this is at least 250 billion US dollars, and therefore we believe for the next 5 to 10 years, we'll still continue to be able to harvest this type of opportunities.